All right, let's get right into our weekly strategic update on the European auto sector. We are witnessing a dramatic and frankly painful U-turn. The entire narrative has shifted. The era of peak EV hype is over. What we're seeing now is a defensive scramble for survival across the entire industry. So here's our game plan. First, we'll define this great EV reversal. Then we'll dive into the immense pressure on the volume giants VW and Stellantis. After that, we'll dissect the premium brand battle, see what's happening with the outliers, and unpack the huge margin threat from raw materials. And finally, we'll wrap it up with your actionable briefing. So what are we really talking about when we say reversal? The entire sentiment has flipped. For investors, the game isn't about growth at all costs anymore. Now it's all about who can survive what we're calling the margin valley, that really dangerous place where the high costs of making EVs meet slowing consumer demand and just crushes profitability.
This brings us to the single most important theme in the sector right now: defensive consolidation. Forget all those ambitious plans of spinning off EV units to chase those sky-high Tesla-like valuations. That's over. The new playbook is all about hoarding cash, slashing costs, and restructuring to weather this perfect storm. It's a massive shift from offense to defense.
And if you need a poster child for the shift, look no further than Renault. Their decision on January 22nd to just dissolve the much-hyped Ampere EV division, well, that's a landmark event. It's a public admission that the whole strategy of separating out EV assets to unlock some crazy valuation has failed. It's a major retreat, and it's setting the tone for everyone else.
Okay, so let's see how this new defensive reality is really hitting the volume players. The pressure on Volkswagen and Stellantis is just immense, and how they're reacting tells us everything we need to know. Look at this number, 2032. That is the new launch date for Volkswagen's flagship Project Trinity, the very platform that was supposed to secure its tech leadership starting back in 2026. Now, let's be clear. This isn't just some small delay. This is a complete tear-up of VW's entire product and software roadmap. They're being forced to squeeze more life out of their current MEB platform just to spread out the costs. It's all about preserving cash, but the price they'll pay is a massive 6-year technology gap that you can bet rivals like Tesla and the Chinese EV makers are just salivating over. So if VW's problem is a long-term tech gap, what's happening at Stellantis is a full-blown near-term crisis. The company is facing a severe volume problem, and it's forcing them to take drastic measures that are, for all intents and purposes, a profit warning to the market.
Here's what you need to know. They're slashing prices in France just to move metal. But the real red flag, the one that should have every investor's attention, came from the CEO, Carlos Tavares. He actually admitted it was too soon to confirm the 2025 dividend. That's a rare and deeply worrying signal. With potential losses from their EV program topping 8 billion euros, all eyes are now on their February 26 earnings call. They need to deliver a credible plan.
Okay, let's pivot and look at the premium segment, because here the story is one of really clear divergence. In the battle between the German giants, Mercedes-Benz and BMW, we have a decisive winner, for now.
The contrast here is just stark. While BMW actually managed to grow its EV sales by 3.6% for the full year, Mercedes saw its global EV sales plummet by a staggering 9% in that critical fourth quarter. This isn't just a slight underperformance, it's a major warning sign. So what's going on? Well, BMW's power of choice strategy, offering customers gas, hybrid, and full EV options on the same platforms, is clearly winning the volume war right now. They're also moving decisively to fix their sales slide in China and are pushing ahead with an all-electric future for their super high-margin M-Performance division. Smart moves. Now, beyond those giants, the pain and the opportunity are not spread out evenly at all. When we look at the outliers, we see some companies in severe trouble and a few pockets of real success. Think about this number for a second. -48%. That was the shocking drop in Porsche Taycan sales in a key quarter last year, a stunning reversal for what was supposed to be the brand's celebrated EV halo car. This demand collapse has actually forced Porsche to cut Taycan production, and it's part of a much bigger problem. Global sales are down 10%, and even worse, sales in their crucial China market are down a staggering 26%. This is a full-blown crisis for the brand. But in stark contrast to all this negative news, you've got Volvo. They just launched the EX60, and honestly, on paper, it looks like a serious contender. We're talking a 400-mile range, lightning-fast 800-volt charging, and that cost-saving megacasting tech they borrowed from Tesla. If they can execute on production, this vehicle could steal some serious market share.
Okay, so on top of all these company-specific problems, there is a massive external shock that is compounding the problem for every single automaker, and that is the cost of raw materials. A 30% spike. That's how much the price of lithium carbonate has rallied just since the start of this year, and that directly threatens the profitability of every single EV coming off the line. So what this really means is that the long-term trend of falling battery costs, the one thing the entire industry was counting on to make EVs profitable, is now threatening to reverse. This creates a really painful margin vice for these car makers. They're getting squeezed by rising costs on one side and softening demand that requires price cuts on the other. It's a brutal combination. So with all this turmoil, what does it mean for you? Let's shift from just analysis to actionable insights. Where should you be focusing your attention right now? Let's break down the key catalysts you absolutely need to have on your radar for the coming weeks and months.
Here are the key takeaways. Short term, it's all about Stellantis on February 26th. Watch for any news on that dividend. Midterm, keep a close eye on Volvo's EX60 production numbers. If they can ramp up successfully, they're going to be a major disruptor. And from a supply chain risk perspective, that lithium rally is a flashing red light for margin compression that's going to hit second quarter earnings. And that brings us to our final thought. While the entire sector is going through this painful reset, the most critical near-term event, the one that's going to set the tone for the market, is that Stellantis Earnings Call. The outcome on February 26 is going to tell us just how deep this crisis really is.